Thanks for clicking! The Canadian government is extending mortgage amortizations for first-time homebuyers. This according to a statement made by Finance Minister Chrystia Freeland.
I knew you'd come.
The move, which expands on a previous government initiative to allow first-time homebuyers purchasing newly built homes to get 30 years amortization, will now allow all first-time homebuyers to put less than 20% down and still extend their loans up to 30 years. Further, the government will also be loosening down payment restrictions, extending the cap on mortgage insurance up to $1.5 million, previously sitting at $1 million. So, what does all this mean?
I got my car back?
Yeah, maybe. So what I want to do today is go over the changes to the mortgage market proposed by Freeland, discuss how that could change buying power, and then go over some implications. As we'll see today, the news from Freeland just came out, and there's a lot of remaining questions on these new initiatives. We will continue to track these proposals on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these changes. Onto the mortgage rules. As mentioned, the government announced today that it would now be allowing first-time homebuyers, those with less than 20% down, to extend their amortizations up to 30 years. Previously, amortizations maxed out on 25 years if borrowers wanted to take the mortgage insurance. That is, if they had less than 20% down. This measure was previously allowed for those who purchased newly built homes as a means of encouraging more construction, but will now be available to all first-time home buyers. So, in summary, if you're a first-time homebuyer and you have less than 20% down, your previous max amortization was 25 years and is now sitting at 30. With that said, these changes are not set to take effect until December 15th.
You cannot afford to wait.
Yep, there's going to be a lot of that. But what does that actually do to buying power? Right now, the current benchmark price home is $717,400. And households with zero debt would need to earn about $160,000 a year to purchase that benchmark price home. However, that same household using a 4.54 interest rate and a 30-year amortization would now be able to purchase a home worth about $765,000. Now, that's assuming the mortgage insurance premium will be the same as it is for 25 years, which probably won't be the case. It'll probably be a bit higher, but give or take, households will have about $40,000 to $50,000 more buying power than they had pre-December 15th.
Yoink!
Further, in addition to first-time homebuyers being able to extend those amortizations up to 30 years if they have less than 20% down, the government is also increasing the cap on mortgage insurance. Prior to the proposed changes, if borrowers wanted to put less than 20% down, the maximum home price was $999,000. However, under the new changes, that amount is being raised to $1.5 million. Meaning, prior to the change, the minimum down payment requirement on a home price $999,000 was $74,900, 5% of the first $500K and 10% of the next. As soon as that home price hit $1 million, a $200,000 down payment was needed. However, that is no longer going to be the case, with borrowers now eligible to put less than 20% down, with homes that are worth up to $1.5 million. Though the government has not been clear on the sliding scale as of yet. Is it going to be 15% of the next $500K? We don't know just yet.
No details, mere details.
In this increase in buying power, these relaxed down payment restrictions are obviously going to bring major changes to the Canadian mortgage market, especially with the Bank of Canada slashing rates and hinting that faster rate cuts could be on the horizon. As we saw, not only will borrowers have a lower interest rate, but they'll also have the option of a 30-year amortization and less down payment. Which begs the question, why exactly did the government do this?
Well, everyone's mad at me.
Yeah, that's one reason. The Financial Post says the move was a bid to woo younger buyers. But I think there's probably another reason at work as well. With the upcoming renewal crisis just around the corner, and former Bank of Canada Governor Stephen Pallaz warning of a recession stemming therefrom, I imagine it won't be long before new rules are implemented which allow current borrowers with mortgage insurance to extend up to 30 years as well, though that is pure speculation on my part.
That's all you need.
And as to how that's going to change the current real estate landscape, well, I imagine the usual suspects are going to be pushing the FOMO heavy. I haven't been on TikTok as of yet, but I can imagine they're flooding in. You better buy before December 15th, as everything changes. And, in a stark divergence from their usual nonsense, that could in fact be the case, as we saw $40,000 to $50,000 more in buying power, the lower payments that come with a 30-year amortization, combined with a central bank that is in the mood to cut. These two measures could add a lot of loosening to the real estate market. This could in fact lead to a real ramping up of the fear of missing out, FOMO, that has been so sorely missing from the market, much to the media's chagrin.
I took up the slack. I handled it.
And for the average first-time homebuyer, well, to the extent to which they were about to buy, then yeah, this will probably give them more buying power heading into the market. $40,000, $50,000 is not nothing. But as we've seen with previous experiences in the loosening of restrictions, even just the loosening of interest rates, even just the prospect of loosening of interest rates, the buying power gained from those loosening restrictions quickly dissipates on price increases, on the bidding up of prices. Further, there is an element of can kicking inherent in these proposals. Take that benchmark price home that we discussed earlier and assume that buyers are putting the minimum down. After 5 years on a 25-year amortization, those borrowers would owe $627,000. But those same borrowers with that same interest rate on a 30-year amortization after 5 years would owe $650,000. So taking on a 30-year amortization does give these first-time home buyers more buying power, does allow them to get into the market, but it also means that a lot more money goes to the banks. A lot less money gets paid down over the first 5 years. Meaning, if home prices do ever reverse, which is not out of the realm of possibility, those home buyers will be much more at risk of being underwater, which is why it was ended in the first place. So, in summary, the maximum amortization for those with less than 20% down, those paying the mortgage insurance, is being increased to 30 years, allowing about $40,000 to $50,000 more in buying power depending on the income. Further, those homes listed between $1 million to $1.5 million will now be eligible for mortgage insurance, meaning borrowers won't have to have nearly as much of a down payment to get into that price point.
The best guy around!
This move obviously carries with it some risks and adds potential fuel to the fire that we could see an increase in housing market activity in the spring of 2025, or even earlier if the FOMO is able to take hold. With all of that said, let's remember that these rate cuts do not occur in the vacuum, despite what we're hearing from the usual suspects. These rate cuts come amid a weakening economy. These rate cuts come amid warnings of a recession, and as such, it's not clear, as of yet, even with these new measures coming from the government, that they will be enough to get first-time homebuyers to re-flood into the market, sending prices to the moon. Questions obviously remain on these proposals, including how much is the mortgage insurance going to be, is there going to be a sliding scale for homes over $1 million on down payments, etc. We will continue to track these developments on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.